The Australian economy moves into the end of 2022 with remarkable resilience given the 300 basis points of rapid-fire rate hikes in the last 6 months and the likelihood of further tightening. The suite of housing-related indicators have weakened when we look at house prices, lending and approvals, and consumer confidence has fallen sharply since May, but consumption remains strong, businesses continue to invest, and Australia's terms of trade are at a historic high, delivering a big boost to national income. So it's not surprising we go into the end of this year with a really strong labour market, an unemployment rate down around 3.5%, a 50-year low. But we know policy works with a lag, even when the transmission is fast in Australia via the dominance of variable rate mortgages. We expect a material weakening in activity, driven by housing and consumption as financial conditions tighten further. There's some early tentative signs of this moderation in retail sales, and we'll see more in the year ahead. GDP for next year we expect at around 1.4%. That's a material slowing from close to 4% that we expect this year. Recession's not our base case, but as the global backdrop darkens, we're increasingly asked how can Australia avoid recession when much of the G7 is already in recession or heading there next year, and Chinese growth is also much weaker. And we think there are 4 key reasons. The first is that faster policy traction via the dominance of variable rate mortgages suggests that the RBA won't need to hike by as much as its dollar block counterparts. The second is that very big build-up in household savings. It's worth about 13% of GDP, and that's a big buffer that households can draw upon to help consumption. The third is really around stronger net migration, and in particular that temporary cohort of students and short-term skilled and unskilled. All of that's come back quite fast, and it's been fairly encouraging since Australia's sovereign border opened earlier this year, and we expect this to continue and help annual population growth back towards its long-run average of about 1.5% and support activity. And finally, Australia's status as a net energy exporter, which is almost all LNG, will also help activity. It'll still be a tough year in 2023. Like most developed economies, activity needs to weaken sufficiently, with some loosening in the labour market to bring inflation back to target. That really is the whole aim of rate hikes. Australia's lagging somewhat on the wage and inflation front, and we do think we'll see a further pick-up ahead. And the risk is that inflation proves sticky with upside to the services component, even with some moderation next year. We expect inflation to be well above the Reserve Bank's target in 23. So the bank likely has more work to do, but the risks have become a bit more two-sided as rates have moved ever higher with this impending slowdown coming into sight. Policy calibration becomes a bit more tricky. I think it's important that the step down in the pace of their tightening in the final quarter of this year after a string of 50-point hikes, that was a really important signal in terms of this changing risk assessment, and it's also probably consistent with getting closer to terminal cash. We look for a couple more hikes in 2023 and a peak in the cash rate of 3.6%. But the risk is probably to the upside. It could be a more drawn-out tightening cycle, and there may be some pauses. For fixed income, the downside growth risks globally and central bank balance sheet reduction will probably keep volatility elevated in rates markets for a lot of 23, despite getting closer to terminal rates. Australian term rates we think will move higher in early 23, but as the RBA gets closer to the end of this tightening cycle, we then expect these yields to move lower over the rest of the year, helped by a similar global path. But the odds are that Australian bonds will likely underperform Treasuries once Fed funds peak above 5%, with scope for more Fed cuts later in 2023.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.